Okay, ladies and gentlemen, I think we will kick things off. We'll assume everyone else is off to the Mayfair room to have a great time. But you guys are in the room where it happens, and it's great to have you all here. Hello, welcome, Womanjika, which is the local language for great to have you here. Actually, it means to come with purpose, to call us all together, and I think that's a really good example of what we're doing today. So, Womanjika to all of you, and I would like to begin by acknowledging the Burunong Bunwurrung and the Wiradjuri Waiwurrung people of the Eastern Kulin Nation, the traditional custodians of the land on which we are meeting today, and pay my respects to their elders, past and present. I extend that welcome and respect to all Aboriginal and Torres Strait Islanders here today. Hello, my name is Simon Thompson. I am the editor of StartupDaily.net and the host of the Startup Daily Show on AusBiz. Many of the people in this room I've interviewed along the way, so it's great to see so many familiar faces. Wow, I think it's about 16 months since we all last gathered at Intersekt 2021, and boy did we thread a needle with that one. Who could have predicted what would happen next? And I don't mean the share price of BNPL companies. It was, of course, an interesting period where Sydney got really competitive with Melbourne and said, that's not a lockdown, this is a lockdown. But we all got through it, and here we are. It's great to have you all with us. I think there are more than 800 delegates here. Hopefully you are paying off the registration fees in for easy payments and supporting your fellow FinTechs. I've been working on my own FinTech. It's an RBA translator. I've got a minimum viable product at this point in time where no interest rate rises. You type it in. At the moment it comes out saying the translation is Donald Trump is the greatest world leader ever. And I kept working on it, and then it was Vladimir Putin is a really fun guy to hang around with and he loves being teased. So I've got some work to do on that. We've got our first panel coming up talking about funding. So Andrea, I might be hitting you up for a couple of mil a little later on. I'm still working on how close to $1 billion my valuation is at this point in time. We have a busy day. We'll probably catch up a little bit of time during our breaks. We are going to break at 10:30 for 30 minutes, but probably a little less, so we get the show back on the road. An hour for lunch at midday, and then another 30 minutes at 3 p.m. It's great. It's lovely to gather, and all of these familiar faces come in and give me a wave. It's kind of like so cool. It's great to be in Melbourne too. I'm from Sydney, and I couldn't help but noticing as I left town, it just felt a little bit quiet, and I got down to Melbourne and I went out for dinner later last night at a time when sort of Sydney would basically be shut down again around about 9:30, and it was buzzing. It's just amazing here. So it's really exciting. Look, I'm not going to talk too much today. The couple of things you need to know, of course, the team from BTC Markets are doing photos out there. So if you need to update your LinkedIn profile, as you head out the door, turn right. They've got the camera set up there. I did ask, they're not turning them into NFTs just yet, but it will be good to have a couple of new snaps, I reckon. Or like me, just keep using the 10-year-old one because it's not getting any better. But anyway, the toilets, of course, are out on the left as you turn, just near where the registration desk was. It goes along there and they're on your right. The queue is the women's toilets. Anyway, without too much more ado, I am going to hand over to the Managing Director. I do want to welcome you here on behalf of Simone Joyce, Chair of FinTech Australia, and another Startup Daily regular, to this gathering. It is so exciting. It is so exciting that it's sold out again. So Rihan, General Manager, welcome. Please put your hands together and give a big thanks and welcome to Rihan Dalmeida.
Thanks, Simon. Thanks, Simon. Ladies and gentlemen, welcome to the 6th edition of the Intersekt FinTech Festival. Just feels like yesterday we had the 5th edition, so yeah, I'm glad you're here again. It's so good to be here at the Grand Hyatt in Melbourne, hosting this magnificent sold-out event. Before I start, I want to say thank you to the amazing team at FinTech Australia, particularly to Lisa Gostinsky, Member Services Manager, Stuart Keane, our Community Manager, and Nick Kavas, our Policy Lead, along with Carlos Antoni and Anita Beckham. We're just that small a team, so yeah. But thanks also to all the support today, including Simon, Rachel hopping on the other stage, the event management team, and Jamie, who's managing the AV. Our sincerest thanks to the Victorian government, who backed us from the early days of FA and are doing remarkable things to make the Victorian startup ecosystem thrive. And to our wonderful sponsors, partners, speakers, and the FinTech Australia board, and of course, our incredible members and community who have helped make this what has now become the largest FinTech event of the year in Australia. Demand was extraordinary this year, so much so that tickets were fully sold out, and I'm sorry we couldn't accommodate everyone. Just means we need a much bigger space for next year, so MCC or any suggestions would be good. We've put together a great array of top international and local speakers, policymakers, and thought leaders. I hope you get a lot of value out of it. Before we officially open the conference, I would like to address some important matters that we as a sector are facing. It is indeed a challenging time in the industry. Access to capital is reducing. Redundancies are taking place across multiple sectors, including FinTech. And overall, it may seem to an outsider that FinTech is losing its sheen. Added to that, the climate crisis is no longer a distant threat, but a problem that must be addressed now. What is encouraging, however, is that founders and leaders in this burgeoning industry have never shied away from obstacles and challenges. FinTech founders are purpose-driven and motivated to solving societal challenges, creating a fair and democratic financial services sector. Built on the foundations of trust and resilience, innovative solutions have been developed to meet the changing needs of individuals and small businesses. In this current state of affairs, the industry has a responsibility to the environment and to society. Finance and capital markets can drive this change using technology and data as key enablers. Increasing gender equality, reducing inequality, and improving financial well-being are steps we all need to take together. We at FinTech Australia pledge to support this in a few ways. As a first step, the FA team and the board of FinTech Australia have committed to the Banking and Finance Oath. This is an initiative by the Ethics Centre. This oath is a pledge of integrity and commitment that aims to increase consideration of stakeholders and decision-making accountability. This is to set the groundwork to bring alignment in the industry's collective goals. We will convene the broader industry to build toolkits, share insights and best practices, and develop key frameworks that will be shared with our members. We will also champion policies that enable faster and more effective change. This will be the new bar we set for ourselves and for the industry to build a sustainable and inclusive world for all. As we go through the next 2 days advocating and celebrating, we continue to believe that collaboration and partnerships are key to achieving our unified goals. Partnerships, not just between fintechs, but with larger institutions, with government, and with regulators to design new solutions to these new problems. I hope that this opportunity before you sets the foundations for creating a more sustainable and inclusive world for all. Thanks so much for joining us, and I look forward to meeting you all today.
Thank you, Rehan. It is an extraordinary time, and FinTech has been the shining star of Australian startups for the last few years. I think that will continue, and I think we'll see it emerge yet again in the conversations over the next 2 days. Now, and I do want to say, you guys did an amazing job in terms of the agenda you put forward for the federal government. I've been covering elections for nearly 30 years. I didn't get to look this old without being on the election campaign trail for a long time. And I just think that you deserve to pat yourselves on the back for the agenda that you set for the sector, how the government, both past and now present, have embraced the ideas that you put forward, because that's no mean feat to get your ideas across. So congrats to FinTech Australia and everyone involved in putting that agenda forward and being able to convince government to back it. So we've got some interesting things ahead, and of course that will be part of the discussion in the next few days. But before we do that, we're going to hear from the Honourable Stephen Jones MP, who is Assistant Treasurer and Minister for Financial Services. Over to you, Minister.
Innovation is driving the thousands of Victorian scientists, researchers, product developers, business owners and creatives every day. So, what will the next decade bring? We know innovation is the key to overcoming our greatest challenges. And we know that for big ideas to flourish, we need to support creative environments. That means investing in industries, commercialising our cutting-edge research and innovations, developing new technologies, harnessing the sectors of the future, and nurturing our talent so the next generation has everything they need to take their ideas to the world. Excited about what's next? Victoria's future is bright. We are an innovation powerhouse, responsive, inclusive, and thinking ahead. Find out more at vic.gov.au/innovation.
That obviously wasn't Stephen Jones. We had one of those moments. Look, we haven't announced the winner of Australia's Next Top Model and got it wrong. So, you know, just a small hiccup to start. But we do have a real live David Latina here. He's the Deputy Secretary for Jobs, Innovation and Business Engagement from the Department of Jobs, Precincts and Regions. So, David, please come to the stage and be you.
Actually, I'm Stephen Jones, so I'm not sure what's going on here, but no. Thanks so much, Simon. It's great to be here in person, and it's great that to see just how excited people are in terms of attending today's conference starting today, and what an exciting buzz there is in the room even this morning. The fact that as frustrating as it is that people aren't sitting down and the conference didn't start, I think it just goes to show just how excited people are, how keen they are to have a conversation and do deals and talk business or whatever. And that's what this conference is all about. So it's absolutely terrific and really inspiring, I think, and there's so much to talk about as well. Before I start, I wanted to begin by acknowledging the traditional owners of the land that we're on today, the Wurundjeri people of the Kulin Nation, and pay my respects to elders past, present and emerging. And I'd also like to virtually acknowledge Stephen Jones, the Assistant Treasurer and Minister for Financial Services. Of course, the FinTech Australia team, who are doing an amazing job at delivering this conference, and its board as well, of course. And also, of course, I think I want to really especially call out all those terrific delegates to the conference that have come from regional Victoria, interstate, and also internationally as well. And we've put on some great weather today in Melbourne, which is terrific, so I hope you sort of enjoy that. And I think, as Simon was referring to earlier, there's a whole lot of things we can do outside of the conference, of course outside of normal hours as well. So I hope that in the time that you have here, and maybe you might be able to extend your time in Melbourne for a couple of days for those interstate or international visitors to do some further exploration of Melbourne, the incredible restaurant and bar scene that we've got here, and the terrific nightlife as well. So I hope you certainly spend time while you're here to enjoy everything that Melbourne and Victoria's got to offer. It's a pleasure to welcome you here today to day one of Intersekt. It's Australia's largest FinTech festival, and it's held right here in Melbourne. The Victorian government's been a long-term supporter of Intersekt, and we're certainly wanting to back Intersekt because it backs businesses like yourselves and everyone in this room as well. And we want to bring together the brightest of industry minds, investors, regulators and policymakers to really celebrate our thriving FinTech sector. And The sector, of course, has played a really key role in keeping the economy churning. It's growing from strength to strength, and sure, from time to time there might be small blips along the way. That's part of business, that's part of innovation, it's part of the world economy. But for overall, it's growing significantly, and it's grown from a value of $250 million in 2015 to $4 billion in 2021. And it's now home to 800 companies, more than 800 companies. FinTech startups and scale-ups are thriving, and that's great. And Victoria's home, of course, to more than 250 FinTech startups, and some of the biggest success stories including Afterpay, Judo Bank, Myob, and Airwell-X as well. So some terrific companies. And our most recent unicorn, Melbourne FinTech Zeller, achieved this milestone in record time of just 2 years, and many other FinTech startups have experienced great growth over the last year as well. And more broadly, of course, FinTech, of course, relies on a vibrant financial services sector, which employs more than 120,000 people and contributes $47 billion to the local economy as well. In terms of Victorian Government's support for startups, FinTech and innovation, we're a big backer of innovation because we think that it's critical to Victoria's economic prosperity, as you would have seen from the video that was recently played. The government just recently announced an innovation statement that really outlines a really exciting vision for innovation across the state and really delivers some key outcomes. The ecosystem in Victoria for startups is already one of the fastest growing in the world, and it's more than doubled its value over the past year to $24 billion. And the great work that's being done, I think, by the Victoria Startup Agency, Launch Vic, on programs like the Alice Anderson Fund and the 30 by 30 program is a real testament to that and the exciting outcomes that those programs are delivering. Of course, for many of you, and across not just the FinTech sector or financial services, but more broadly, one of the biggest challenges that businesses face is, how do I get the talent? How do I secure the talent? There's a real skill shortage, of course, not just in this sector, but across the board. And there's Victorian Government, of course, is trying to do its best and it's to actually promote people to get into the digital sector. One of the great success stories that is a program Victorian Government announced about a year ago and we've been rolling out, called the Digital Jobs Program. And it's an exciting program to sort of enable to upskill mid-career Victorians to support their transition into digital careers through a combination of short micro-credential training and also a short time with a business, 12-week period with a business that enables them to get them job ready to work in the digital sector. From there, businesses will say, we'll take care of the rest in terms of their further development and enhancement. But it's certainly an exciting program, and we're rolling out 5,000 places through that program as well. So if you need any more information on that program, I would encourage you to speak to some of our Victorian Government representatives that are here today at this conference. Also, a really exciting initiative that many of you would be aware of is the Summertech Live program, which matches tertiary ICT students and graduates with Victorian businesses to solve digital challenges over the summer period through a short internship as well. So it's super exciting. So ultimately, what we're aiming here is to provide an environment that supports your innovation, your growth, your competitiveness, and enable you to pursue your business opportunities as well. And clearly, talent is really at the heart of this, and Victoria Government's really proud to be able to work with industry, work with Intersekt and other industry organisations to promote that ecosystem here in Victoria. So finally, I just want to say thank you for allowing me to speak for a few minutes today. The Victorian Government's incredibly proud to continue to working with the state's FinTech sector and to support Intersekt 2022. And I certainly wish you all the best of luck and a really successful conference. Thank you.
Thank you, David. And yes, I have taken your advice. I planned ahead. In some ways, it's redundant because the Swans beat the D's last week. So I'm going to Friday night's game and I will be cheering on the reigning premiers, Melbourne. So I hope to see you all there. And then, of course, we will use, as Rehan suggested, the MCG for next year's Intersekt. I do want to give credit to LaunchVic, who I talked to a lot too, for some of the things that David said. And 30 by 30, I love the ambition of that. That, of course, is to create 30 unicorns in this state by 2030. That's underway. And then things like the Alice Anderson Fund, which is $10 million to invest in female founders working with private capital. It's such a good idea that we've actually nicked it for New South Wales and are now doing a similar thing with Matt Keane up there. Let's get on with today's show. Now, if you are a mad tweeter or Instagram or TikTok, whatever your choice, hashtag Intersekt22 is good. Hashtag FinTech, hashtag FinTech Australia if you're keen as well. We're going to talk plenty of things today. We've got partnerships, CDR, ESG, CX, KYC, venture debt, VC trends, global trends, and going global. It is a packed program. So let's do this. And we're going to start with accessing finance and capital for sustainable business growth. Please put your hands together and welcome Andrea Reynolds, the CEO and founder of Sweep Funding, and a man I go to every time I know nothing, which is quite a lot, Dr. Demetrios Salampassis, from the Director of Master of Financial Technologies and Assistant Professor of FinTech Innovation and Entrepreneurship at the Swinburne School of Business. A big yay! Come on, guys!
Hello and welcome. Thank you so much for the kind invitation. Welcome back to Melbourne and to Australia. Thank you for joining us today.
Thank you for having me.
So, sustainable business growth. What is your definition and what are some key components?
Yes, it's interesting that we're even having that discussion. I think pre the current state of the market, when we're all out fundraising, a lot of it's around growth at all costs. And so it was always looking at top line, top line, top line. I think when you're out raising now, one of the new trends is looking at capital efficiency. And I think this is good, by the way. I think this is a good trend that we're seeing. So now it's not just good enough to say my growth over the last year has been X. It's I applied the capital and I was able to generate X revenue. So what it's about is it's not necessarily that you're in a state of profitability right now, it's that you have a genuine path to profitability. So I think where we're at is adjusted perceptions, but I think we're actually moving in the right direction of creating more sustainable businesses moving forward.
And do you think any impact on that in terms of reconceptualizing and recontextualizing sustainable business growth?
I think it's more the phase we're in now and the market outlook. There were winners, there were losers. COVID was about growth at all costs for businesses like e-commerce businesses where they were seeing upward trends. For others where it was a negative impact, it was around extending your runway. But the phase we're in now is about the markets and where we're at and the market outlook. And so it's not about, battening down the hatches, it's about actually how are you going to grow through this phase. So I think anyone who's at the early stages, growth stages, when we come through this, we'll probably be the best prepared tech businesses ever. We'll have gone through a 1 in 100 year event and we'll have gone through a major energy crisis, major recession. And if we're still standing at the end of that with a sustainable business, I think we are the businesses to be investing in.
Brilliant. Now, slashed valuations, employee redundancies, reduced funding in FinTech. What are some key observations of yours and what kind of initial lessons should we learn?
Yeah, maybe it's because I'm an entrepreneur and we're always eternal optimists, but actually if you break down the numbers, we all see these major headlines of slashed valuations. The decline of valuations has impacted Series C and thereafter, so over 40% decline. Series B, 25% decline. But actually, if you dig into the numbers, seed and Series A has still increased by 18% year on year in terms of valuations. And if we all think about it as well, I don't think we should all be doom and gloom and, oh, let's forget about accessing finance here. VCs have a lot of dry powder. They raised at a time when interest rates were low. They are still sitting on a lot of funds that need to be deployed. And if you're in seed or Series A stage, you are young enough to not have so much fixed overheads that you're having to let people go, etc. You'll be at the phase where you're riding this cycle out. Mm-hmm. So I think for businesses that are at seed Series A, don't be despondent. There is a lot of funding out there. Another point specifically for Australian businesses and why Swoop funding exists, we started because we could see global trends happening. So with data sharing, with frameworks like CDR and open banking is becoming global now. Cloud accounting is available. Finance is becoming borderless. So if you are raising, don't just think about the Australian market. And I'm referring to debt as well as equity. Mm-hmm. So don't just think there's VCs in Australia or there's lenders in Australia. The majority of fintech lenders now are multi-jurisdictional. So we just funded a business this week through the US and the UK, not through an Australian lender. And so I think the options and the market, it has never been better for a business that's looking for growth funding, albeit it's tempered with, yes, more realistic valuations, and yes, you're going to have to prove that your business is capital efficient. But these are all things we should be proving to ourselves as business people anyway. Mm-hmm.
And do you think that investors nowadays become much more selective or a bit more impatient as well?
I think investors are becoming more responsible, and that might be a little bit controversial to say, but I think sometimes the FOMO effect of VCs has actually led to, I think, the crazy valuations that we've seen, the crazy multiples that we were seeing. And I also have I'm going to be a little bit controversial here. I think 30 by 30, that it's great to have aspirations of creating unicorns, but sometimes we can all get consumed about reaching unicorn status. This is about, are you developing a business that customers want and that you're doing that in a sustainable way? Sometimes that sort of race to get to unicorn status can actually lead to huge inefficiencies in organizations, which is why you see this increase in employees, reduction in employees mm-hmm. when the valuations are hit. So for me, I think it's more around, are we creating businesses that are sustainable, that customers want, mm-hmm. and that we're actually delivering a service in FinTech that reduces friction and improves people's lives. I mean, that's fundamentally where we want to go with this.
So you would also suggest that growth is correlated to externalities, basically?
Yes. It's funny, I mean, I was an accountant prior to starting my tech business, and I don't know, back in the old days when you started a business, it was, here's my business strategy, here's my product strategy, and you would then look at your finance strategy to support that. Then the world kind of changed, and there was a lot of VC money around. It was like, people were making business decisions based on, how do I get to this valuation at the next round? How do I get to raise my next 100 million? And it was almost forgetting the customer. It was forgetting the actual business strategy. I think the phase we're moving into now is we're going to find a nice balance. It's going to be about, yes, how do I reach those valuations, but with a capital efficient business. Mm-hmm.
I remember when we had our initial conversation, I was so fascinated with what you told me about the fact that lots of business owners FinTech entrepreneurs, management teams, they lack fundamental finance skills. So there's an increasing gap in financial literacy.
Yeah, it was, it came from my initial work of, I had a corporate finance firm and I wanted to work with businesses that could never afford corporate finance advisors, hence why I had to find a new business model and create a tech platform. But one of the things I found is, SMEs are essentially what the economy relies on for growth. We have all of these 2.4 million business owners, and the finance industry and everyone expects all business owners to be financially literate. They expect them to know what gross margin is. They expect them to know what debt service coverage ratio is, liquidity ratio. And the majority of business owners did not start their business as an accountant. They started their business because they created something new, they invented something. And what I found when I would go out and work with a lot of businesses was they would say, oh yeah, go speak to my finance person, or my bookkeeper's coming in on a Thursday. And so I did a lot of research into this, and there are very poor levels of financial literacy generally in the public. Now, maybe in this room, no, because we're in the FinTech industry. But if we're talking about serving business owners, which is what I do for a living, we have to acknowledge that financial literacy levels are low. So if you're a lender, don't assume that your business owner knows what you're talking about. The OECD has done numerous reports on this, and it's a real, we have to get to the bottom of this. So for us, with funding, we don't just match them to funding, we're actually showing them the insights and the metrics, and we call it the Fitbit for their business. You don't necessarily know when your personal trainer says what your BMI index is, you just know it has to go down. And so it's about giving them those metrics that they have a greater attachment to their numbers. So as I say, I'm not talking about this audience in particular, I'm talking about the general public of business owners. And this is a global issue, it's not just specific to Australia. In Ireland, for example, the government did a survey on 53% of business owners did not actually look at their management accounts.
Wow.
So, yeah.
I'd like to go back to the funding aspect, and I picked what you said about that there is funding out there. So is it about organizations and ventures not knowing where to look, or being only obsessed in a particular source of funding?
Yes. Well, it's not that they don't know where to look. It's a combination of things. Time. We have limited time. We're putting out 1 million fires every single day. You're focused on your customer. The other one is knowledge. You may not have the time to go Google everything. And again, that's why I started this. I was helping other businesses raise funding. I was doing loads of Googling. I was trying to match them to government grants, going down a rabbit hole, finding I wasn't eligible eventually. I didn't know when I was in Ireland that I could raise in the UK market and have those funds flow back to Ireland. So it was actually navigating that landscape and thinking, well, if I'm finding it this hard and I do this for a living, every other business owner and founder is going to be experiencing the same. So how can I deliver those results to them in a time-efficient way and remove all the admin side of it? So yes, it is like the more you know, the more options you have, right? So, and the more time you have. So you might be sitting here and saying, I've just got a no from my bank because I have no assets to secure a loan against, when in actual fact there are hundreds of lenders now, not just in Australia, as I've said, that will absolutely look at that. And so, yes, it's about, if you think about it, the alternative finance market here, when it started, after year one was 100 million, 3 years later it's over 1 billion, and we keep going. So optionality is there. You just don't have the time to curate that list of what is right for your business right now. That's what we do.
And based on your experience and work, what kind of options would you see as more mainstream or more famous?
Well, if you, again, banks Of course, actually in Australia, bank acceptance rates are very high versus other jurisdictions. So it's usually around 50%. In Australia, it's up at 80%. But actually, if you look at what they're approving, it's businesses with very strong balance sheets, with something to secure that loan against. The big issue, particularly in Australia, and it's not just Australia, but that growth capital, unsecured lending for 250,000 upwards. That is a real issue for high growth businesses that are asset light. But having said that, there are now multiple new products like revenue-based finance, even cash flow lending, large unsecured cash flow lending, that is out there. But again, these are emerging. Every quarter there's a new product arising. But if there is one gap I've definitely noticed here, it's that gap. And that's where we're filling it with lenders from other jurisdictions.
Now, I'd like to ask about your presence here in Australia, and also what has your experience been so far?
So experience so far and is, my God, it's really hard to set up a company with ABN. I was like, they still have fill in the forms and post the forms. And I always equate it to, you know, when you land in a new country and you can kind of get a feel for how easy or hard it's going to be to do business by the airport, how easy it is to get through the airport. Well, registering your company, so you're coming here, you want to invest here. ABN, I think we were going to talk about what else can the ecosystem learn from other jurisdictions. ABN needs to get a really fine open API and become digitized. I think the government side of digitization needs to speed up a bit here. That was the hardest bit. We launched here during COVID, and I think it was a bit of a COVID myth. Oh yes, you can. We were, you know, having roundtable discussions with all the major banks, and we thought, oh, we're not at a disadvantage by being at home because everyone's at home in their kitchens. And so we thought, we launched here, it was fine, but the learnings are that if you truly want to launch in a market, you have to remember there's a customer at the end of that, right? You can never take your customer for granted. So you have to go and live, eat, sleep, drink the market that you're launching in. And that was my fundamental lesson. The difference between launching and running the business here during COVID and now is you start to pick up all the nuances of a market. You start to pick up, well, what you thought would work may not work. And I think that's probably my lesson of going international. We are in 5 markets now. And we launched here before the US, but we took all the learnings from here, and we took our time in the US to really get to know the market before we launched there.
So you would say that you don't have a one-size-fits-for-all international strategy, basically?
No, I think it's easy. Look, as tech companies, the easiest part of going into another market is your tech. Of course, you've built your tech to scale. You've built probably a framework where you can add on further APIs that are specific to that market. That is honestly the no-brainer bit. It's the execution bit. It's the finding the people. It's that you as the founder truly getting to know your customer and realizing, well, yes, SMEs universally have an access to finance issue, but what specifically are the issues in the market that I'm trying to serve? So that and the people side are the most difficult parts. What's new? What's new in the world?
If I may ask you, how long did it take till the decision to start looking into the Australian market and the moment you actually got in here?
Truthfully, a week. Yes, and that's thanks to Enterprise Ireland. Yes, it's his fault. Happily his fault. You know, it was COVID, and we had more time on our hands because we would have been normally out at conferences like this in our domestic market. So we had more time on our hands. We had done all of the fixing our systems internally and Scott actually said, read all of this. We'd already looked at the Australian market because similar to the UK, CDR, alternative finance market was growing. The entire ecosystem was really starting to take off. But the speed with which we got here was literally a week. And then, as I say, you get the easy boxes ticked off, and then you realize it comes down to execution and people and knowing your market.
I really love your global perspective and your global thought leadership. And since you have presence in multiple countries and you have been in multiple countries doing business, how easy or difficult is for a fintech startup to actually go global?
I think every fintech has to think globally. There's no point in thinking domestically. Then you're not a fintech. Like, let's be honest here. You're solving fundamental issues in the system. I have not met a fintech yet who has not got a global outlook. Yes, we have to start somewhere. You have to build your market share. You have to build that product market fit. But as I say, I think the hard bit is not your tech. The hard bit is the people and the execution and knowing your customer and knowing the nuances. There is just no getting away from it. You have to put in the investment of time. And I think fundamentally it has to be the founders that put that time in. What you have to do is make sure wherever your main market is, you've got everything systemized, set up, it can live and breathe without you, so that you can move on and invest as much passion and time into the next market as you did in your first one.
Do you think COVID has enabled that global mindset? Has it made it more easy or more difficult?
I think COVID actually has done a couple of things. And again, I'm being an optimist here, but we were just hearing from the minister there. Access to talent is that, access to finance and access to skills are the two stumbling blocks to growth for all of us. I think what COVID has done has created remote working. So all of us now have distributed teams, and that's the norm now. So our team, we have a team in Brazil, South Africa, UK, Australia. I mean, they're in multi-jurisdictions. And so we've just hired someone in Nigeria, and it actually helps us because we're now getting a 24-hour round-the-clock team, tech team. So actually, again, great that the minister, but we can't all wait for visas to come through. We can't all sit here and say, oh, I still can't hire another, front-end engineer. Now we just all go, it's remote first, if that's what you want. And most people have moved to hybrid working anyway. So again, I think our mindsets have changed. We don't just constrain ourselves to the market, which is our domestic market now.
And very briefly, what's your presence here in Australia? What do you do on the ground?
So we have a team of 10 and growing. And as I say, that's where you have to put the investment of time in to understand really what's the makeup of that team and what do they need next. Where's the market pull? So the market pull is slightly different here than it is in the UK. So then you have to build your team according to that. So we're currently based in Sydney, about to open an office here as well. We'll just keep growing as the market comes to us.
Brilliant. Before I'm going to open the floor for a couple of questions, in your experience and in your global reach, what could be some lessons for the Australian fintech ecosystem to take on board?
I think it's in a really good position. I think if you look at some of the CDR is so exciting. I can't tell you, when open banking launched in the UK in 2018, I mean, talk about MVP. Oh my God, it was the standard of the APIs, the data quality was just really something to be left desired. And when we started, the adoption was so low. I mean, it took a year to get the first 1 million active users of open banking, and now it is absolutely flying. So when we started, we had like less than 5% would integrate their bank accounts, and now it's 55%. And it's just becoming the norm. So if there's one thing, it's you have to create that virtuous system. So government has to say, make your tax payments via open banking. Banks have to not build an API that just is compliant. They should look at their peers in other jurisdictions that went ahead of them, and not just do an API, like see it as an opportunity, not a mandate. And so I think there's a lot to be learned. You can look at countries like Estonia, where their e-governance is it's world leading. So I think the more that we can reduce friction like that and create a virtuous cycle, it all comes down to engagement at the end of the day. Absolutely. For a finance ecosystem
Absolutely.
to work.
We have time for 1 or 2 questions, so I'm happy to open the floor and get questions from the audience. I'm sure there will be some microphones around, so feel free to raise your hand if you have any question for Andrea. Yes. Here.
Hi, thanks. And thanks for your presentation, Andrew. Really nice hearing from you. You mentioned something about Ireland and, the Enterprise Ireland. So are you incorporated in Ireland, and how do you expand globally? Are you incorporated in Australia as well, or how does that work?
Yeah, yes, our parent company is Ireland, and then we have subsidiaries in each of our countries that we operate in. And just by your accent, we went through the whole, how do we incorporate in the US? What's the best way for us to go? But yeah, all of them are subsidiaries at the moment. And in the UK, we have a branch and a subsidiary. Little tip for anyone who's raising finance, it's got to do with you then have access to the early stage investment market in the UK. It's a tax relief scheme scenario. But yeah, they're all limited businesses in each territory and fully operational in each territory. And then our IP lives in Ireland, of course, and then we operate, obviously, a transfer pricing model back to Ireland for the IP.
Thank you. Any other question? I may just have one last for you. So what would be your final message? What would be some advice you would like to share with us in terms of how do we actually battle with all the uncertainty, all the volatility right now, and what's next to come?
See it as an opportunity. See it as an opportunity to show how your business can not just survive, but actually grow. I think recessions are where it all happens for young businesses. If the world was fine and there was nothing challenging going on, we would be fighting against the incumbents, and it's hard to get institutional customers to change their minds when the status quo is fine. They don't need to be thinking about these things. So I actually see it as the best time to be starting and growing a business. And then the other thing I would say is, don't just think globally for your customers, think globally for your finance and your fundraising strategy as well.
And what is your strategy as SWOOP for the next, let's say, couple of months and maybe 2023 as well?
It's to become the most loved funding platform in Australia for businesses, and then once I've that achieved, it's to do the same in the US. I truly want this opportunity of borderless finance and empowering every entrepreneur to be financially savvy and have access to that market, similar to the public markets. That's the phase I'm really trying to fix.
Brilliant. I love this borderless approach that you are experiencing and explaining, and I think this is really something that all venturers and all business owners need to take into account, that the world has no borders and there are so many opportunities. And I think technology is actually enabling that quite a lot, to reach out to talent, to reach out to funding. It's just a matter of maybe having that click in your brain and thinking beyond borders. Thank you so much for joining us today, and looking forward to seeing you again. Thank you so much. Thank you.
Thank you, Dimitrios. Thank you, Andrea. I was fascinated by a couple of comments there. Of course, the lack of financial literacy is an extraordinary one, an extraordinary opportunity along the way. And I agree with you on the government and the paperwork. It's like the fact that they still ask you for a fax number when you fill out this stuff is like, there is a generation who doesn't even know what a fax is building billion-dollar companies right now. It is extraordinary. And I have this vision of people in government departments on Commodore 64s, sort of putting all of the data in along the way and then onto a floppy disk. All right, one of the plans for today, because we did start a little bit late, is we're going to shave 5 minutes off, so our next panel knows that. Dimitrios, well done. You did it without me saying anything, so fantastic. And so we'll finish at about 10:45. That's about 15 minutes later than we planned. We'll have a slightly shorter morning tea and get back in here at about 11:10. Well, let's get to our next panel. And I think it was Salim Ismail who said, if you're not disrupting yourself, someone else will. And we're going to talk about conscious disruption now with Daniel O'Turley from Unloan, Sapun King Jayawardana from X15 Ventures, and Tess Sutherland from CBA. Your moderator is Justin O'Donnell from Doshi. Ladies and gentlemen, please put your hands together. Welcome them to the stage. Grab one. There should be two more there.
Thanks for joining us, everyone. We're here today to discuss a story of conscious self-disruption, which is the story of Unloan. To help us with that story, I'm joined by Dan, who's the Chief Executive of Unloan, Sapun, who's the Chief Product Officer of X15 Ventures, and Tess, who is the Head of Banking Services for the Commonwealth Bank of Australia. For the next 25 minutes, we're not just going to talk about the journey undertaken by Unloan, CBA and X15, but we're going to talk about the tech integration and strategic buy-in required to be able to build a disruptive home loan business inside the largest bank in Australia. And we might have some time for questions at the end, but we're trying to sub it down. Oop. Closer, sorry, there we go. So to kick things off, we're going to do a quick introduction. So Dan.
G'day, Justin. Daniel Etley. I'm the CEO of Unloan. Previously spent a decade in PropTech with realestate.com.au and as CEO of HomePass, but now the proud leader of Unloan.
Sapun.
Hey everyone, so my name's Sapun King Jayawardana. I've been at X15 for 3 years since we launched and the Chief Product Officer there, and we try to connect people like Dan and the Unloan business with Tess and CBA more broadly. I've been in and around this space for the last 8 years talking about corporate and startup innovation in our old innovation labs that CommBank set up, so I know some of the things that we have to get right, some of the challenges X15 is staring into.
Tess.
Good morning, everyone. I'm Tess Sutherland. I'm the Head of Banking Services at CBA, and I lead the teams who activate banking services for ventures such as Unloan.
Great. So I think to kick things off, Dan, can you tell us a little bit about Unloan?
That would be a pleasure. So essentially Unloan's our reimagining of what we think home loans should look like in a digital generation. You know, it's not rocket science. We think things should be a lot easier when you make things digital. So we've focused on 3 dimensions of easy. One is we wanted to make the product home loans easier to understand. And we did that by just focusing on one simple low rate for everyone, getting rid of all the complexity of multiple rate variations and conditions. The second part is that we wanted to make it easier to live with once you had the loan, and the way we brought that to life is by adding a discount that gets better and better and better every year you're with us. And the third way we thought that it would be nice to make it easier for our customers is to make it easier to get. Home loans should not be a difficult process. We think they have been traditionally much harder to get than they ought to be. So with Unloan, the online application process can be completed in as little as 10 minutes.
And how did Unloan come about?
So I've been floating around PropTech for the last decade, as I mentioned previously, and it's hard to be in PropTech without also bumping heads along the way with the financial journey of customers. So I've been sort of long eyeing the space around home loans as I've helped people in their home loan search journey through realestate.com.au and other ventures focused on the PropTech space. When I sold my previous venture to an ASX listed company, I started looking for ways to bring that to life.
And did you ever think about doing it? I know I'm asking you all the questions, I will get to you guys. But did you ever think about going in alone?
Of course. I mean, you've got great agencies as an entrepreneur, especially if you're venture backed as well, and the pace at which you can do things. But when you think a little bit more deeply about FinTech, it's hard to escape the primacy of brand and balance sheet. Lending operates on relatively small margins and needs a lot of scale to get to a viable business. So, it was clear to me, sort of after a little bit more thinking, that it would require, to make Unloan happen, it would require the backing of a bank. So I started having a look around the market. Of course, the downside of working with a bank traditionally is it's very hard to work with a very large regulated entity. Luckily for us, at the same time as I was looking for the perfect bank partner, X15 was born, which helps and is designed to help ventures more easily access Commonwealth Bank services. So after sort of a little bit of a honeymoon period and making sure that our values aligned and the mission was mutually exciting, we very quickly decided to build Unloan as part of CommBank in partnership with X15.
And so you talk about quickly. How long did it actually take?
Yeah, quickly is always relative in finance, isn't it? So there's probably two processes. One was obviously pitching the idea and building that sort of shared conviction in Unloan as a good opportunity for CommBank to back. That was actually surprisingly quick. X15 at the time was just set up and was ready to hear and quickly assess venture opportunities. That was one of the promises, that we would, X15 understood the space, so could get to a decision relatively quickly. It was ultimately approved by the CBA board soon thereafter. Post that approval, it took us about 2 years of building in collaboration with several CBA teams to get Unloan to market, and that we launched in May of this year.
So Sapun, what about X15 Ventures? So can you talk a little bit more about your involvement and how X15 Ventures helps ventures like Unloan?
Yeah, sure. So Dan was talking about the journey that he's been on and Unloan over the last 2.5 years. We've actually been on quite a similar parallel journey for just as long. So if I take you, to answer your question, if I go all the way back to when we set up X15 and the problem we're trying to solve, hopefully this resonates with a lot of people in this room. The problem is, on one hand, we know if you're doing experimental businesses like Unloan was back then, within the context of a large organisation like CBA, where it's designed for very mature features that serve millions of Australians, that's really hard. But on the other hand, if you're genuinely standalone and you're a good team in a co-working space, to get access to scale assets, to actually grow your business and integrate into large organizations, it's really hard, right? And so how do you get the best of both worlds? Reality is, hopefully you all kind of have appreciated this over the last 10 years, I certainly have, there's a lot of cynicism in this space around the conversation of how do you get that handshake, right, between corporate and startup. And so when we set up X15, we said, well, the only way we can actually deal with that cynicism is two things. Be really authentic around the fact that this is hard. It's a really hard problem. And we have to set up X15 in the right way. So that means a different tech environment to the group, a different way that we look at risk and control processes, a different setup in terms of our operating model so we can support Dan and entrepreneurs like himself. And then secondly, instead of sitting here in a panel talking about the hope of doing it, let's wait till we actually have some real proof points. So, 2 years later, really excited that we actually have a real amazing proof point, because the Unloan business is a fantastic example of how you can get that connection right between startup and some of the really powerful assets that CommBank can bring. So, I'll let Tess talk a little bit about that.
And I think that's a good segue across to Tess. So, Tess, from a technology perspective, why was CBA interested in even going down this path? I think being the #1 home lender in Australia, why partner up with someone like Unloan?
Yeah, I think driving digital innovation is core to CBA's technology strategy. So, the partnership with Unloan was really timely as a way of us thinking differently about how we, continue to evolve our systems, continue to, resolve for resiliency and risk issues, but also, unlock speed for innovation in our own digital channels. So, it was a really good time, and working with Daniel and the Unloan team were a great sort of slightly demanding sort of first customer, and we were able to use that to start to shift the mindset within the bank and start to think about, okay, how do we create capabilities that, and expose the capabilities we have, I suppose, by creating access points for ventures such as Dan, and also sort of new internal innovations as well.
And so how do you guys all fit together? I think that's probably the next bit of conversation. We've got Unloan on its own, we've got X15, the glue, we've got CommBank that has all the services. What role did each of you play? Maybe Dan, you could kick us off.
Yeah, sure. The demanding venture. I think so. Firstly, we're set up as a division within Commonwealth Bank, but very independently operated. So we've got obviously its own CEO, which is myself, and I'm supported by the full suite that you'd typically expect of any venture. So product, marketing, design, operations, risk. Who else have I missed? But typically full-fledged operating capability within the team, and we're also then plugged into CBA probably in two major ways. One is that we use CBA's banking and payments services, and that's made available to us via a newly developed set of APIs, which I'm sure Tess will want to speak a little bit more about. And the other one is the access to specialists, and obviously you have legal, HR, which are valuable, but probably the most indispensable one is the line 2 risk function, which helps us make sure that we remain safe and obviously compliant with our responsible lending obligations.
Do you want to jump in, Tess?
Yeah, sure. So Dan touched there on the banking APIs. One of the challenges we had when we embarked on this partnership was, how do we let Unloan operate as a venture, and the speed and the pace and the agility that they had as a venture, but as CBA still sort of, balance the risk and the complexity that comes with a legacy and very large and complex banking tech stack. So to do that, we implemented or built, as Dan said, a number of banking APIs and exposed those securely and externally for Unloan to call. Those APIs allow Unloan to create accounts and customers and link the two within CBA, allow Unloan to access our payments capability, disperse loans, execute payments between transactions. We take all of that data and we flow that into the existing capabilities within CBA so that we can use regulatory reporting, comprehensive credit reporting, capital, treasury, etc. So leverage that data and those all of those functions that we have within the bank.
And Sapun, how do you glue it together?
Yeah, well, we're the glue, as you said, Justin. So echoing what Tess and Dan said, we essentially think of ourselves as a platform, right? And I think the X15 model, it's complex. It's complex to explain, but we think there's a lot of magic in it if we get it right. And so our platform, if you think about it, we essentially have a set of services and we say, hey, Dan, we want you to do what you know best. And some of the entrepreneurs in this room would hopefully resonate with this, which is be an entrepreneur, right? Pivot your business, focus and obsess on your customers, make a delightful product. But at the same time, we have services to people like Tess that say, do you know what? Dan looks trustworthy, but you don't have to trust him. We know you can't trust him, right? So we will stand behind Dan. We will provide that assurance to not just Unloan, but the other ventures that we also provide support for. And so to break that down a bit, we think of the platform in 3 words. So we think of it as pace, we think of it as scale, and we think of it as safety in the middle. And so I touch a bit more on that. So on pace, we want Dan to operate with the pace of a startup. To get that, to really affect that, we provide tech services. We enable Unlearn to use modern and emerging SaaS tools. We have an operating model where we actually are venture-focused rather than corporate-focused. And we have a community of ventures. And so hopefully, from learning from the Unlearn experience, the next time we do an Unlearn or we invest in an Unlearn, well, actually, it might be that much faster. Now, for startups in this room, that's not that sexy, I get it. Like startup pace, we're already operating there. But for us, it's really important to get that right. And then on the scale side, Tessa's already touched on this in terms of some of the integrations that we enable Unlearn to access. But if you think about some other assets, the yellow diamond, I think everyone in this room knows the yellow diamond, but everyone in Australia knows the yellow diamond. That's really powerful as an asset, right, that Commonwealth Bank has. And then when it comes to distribution, we have a venture to kind of really bring this to life. We have a venture that does conveyancing, and they've built this conveyancing platform. But the really exciting thing for us is we turned on distribution on the CommBank app, working with people like Tess. And basically now, if you have pre-approval across CBA pre-approval for a mortgage in Australia, you get a notification that says, why don't you check out this conveyancing venture? And the moment we turned that on, we saw a 10 times growth in that venture, right? That's the power of distribution. And so if you are in the market, by the way, for buying a home and you want conveyancing, it's called Home In. Check it out. It's an awesome venture. But as an example, going back to the point around, we don't want to just talk about this. We actually want to demonstrate it. That's a really great example of scale. And then if you get to the point of, well, how do you marry these two worlds? Well, how do we provide the right level of safety? That's critical. And for us, and Dan's touched upon this, we're going to set and create a team of people that come from cybersecurity, procurement, legal, risk, etc., but dedicated to venturing. Very different. Not raise a ticket and talk to someone in the group, but actually understanding venture context, but also come from a corporate. And because we're new, what's really exciting for us is we have an opportunity, we have a greenfields opportunity to say, actually, while you're focusing on your business, Dan, why don't we think about embedding in some of these controls and practices from day one? And so Unlearn is not enterprise ready in 3 years. It's enterprise ready now. It's built to be enterprise ready. And so when these ventures scale through some of these assets, we don't need to then say, hang on a second, now you need to re-architect, now you need to change. So that's the model. It's the pace, the scale, and the safety. It's the interplay of those three words. I can talk about this like it's really easy. It's not. It's really hard. We sometimes get it right. We sometimes get it wrong. But we actually have made a lot of progress, right, in terms of actually trying to get that balance right. And we fully believe there's magic in that.
And so if we shift the conversation a little bit to almost like the elephant in the room around the sensitivities of that conscious disruption within a business or the bank, what was it like launching what many would perceive from the outside as a competitive product to yourself? Commonwealth Bank and Unlearn. Dan, do you want to go?
It was the magic, as Soup says. No, it was, it's really interesting. So the first, I think, response would be, isn't Unloan competitive with CommBank? It's obviously in the home loans game, as you said, and it's a lower price for a home loan. It's actually incredibly complementary to the Commonwealth Bank's primary business. So if just in terms of Commonwealth Bank's current servicing pool, it's Australia's leading bank, servicing 1 in 4 all home loan mortgages today, so incredibly large footprint, and with that large footprint, obviously a lot of variation in the products to serve such a broad audience. But there was one very small but growing segment of customers who were perhaps underserved by that broad offering, and that is those customers who are prepared to deal directly online, happy to forego some of the frills and fees and sort of nuanced product features, but in return for a slightly sharper price. So that's Unloan's distinct offering for that distinct customer segment. It's probably single digits in terms of the percent of the overall market of home loan offers, but like I said, it is growing. The other sort of important part that comes with offering a simple no-frills product at a slightly better price point is that you need also a lower cost operating model to justify that and make that viable. So Unloan's also built with the premise that we're stripping out not just the complexity for customers, but also the cost profile associated with bringing that offering to market. So incredibly digital DNA in how we run, very efficient in its operations, very, very high ratios of loan applications to lending specialists to assess, and of course, rapidly evolving and continuing to get better and better in terms of the technology automation we apply behind each and every process within the Unloan business.
And in the last couple of minutes that we've got left, one question, and I'll do the same for all of you. If you could give any advice to anyone in the room around key learnings, takeaways for teaming up with someone the size of CBA using X15 Ventures or launching a conscious disruptive business, what advice would you give the room? Tess, do you want to go first?
Yeah, sure. So from a corporate perspective, there was a couple of things. So one was, we used this to shift that mindset, to start thinking about not just building an outcome, not just sort of building an API that Dan could call, but actually creating something that had value beyond Unloan. And the way that we built these services for Unloan makes them reusable, and we're accessing them for other capabilities, both within the bank and for other ventures. And I think the second thing was this was a totally novel way of delivering within the bank, and so we really had to redefine roles and responsibilities. Who's doing what? How do we partner across the three? And the three of us obviously work very, very closely together and have done for some time. And how do we create that effective working relationship and set that up?
Dan?
So it's always a conscious trade-off. I think for most ventures, you're trying to bring your belief of the best possible product to the widest audience as quickly as possible. And for us, and going back to my thoughts about banking, is that the primacy of the brand and strength of balance sheet are really important for this sector in particular, home lending. So for us, it was a straightforward decision. It was well worth the additional investment we'd have to make to work effectively with a much larger organisation. Similarly, I think it's wonderful that Commonwealth Bank has chosen to also provide vehicles like X15 that make it easier to work with the power that CommBank can provide in a way that lowers the effort to outcome ratio for the venture, and that's getting better and better all the time as well. So I think, again, conscious trade-off. For us, the benefits have been well worth it. Certainly, the yellow diamond that Soup's referred to, that puts us in the consideration phase that we wouldn't have had if we weren't partnered with CommBank for many customers, that this is an offering that I should consider because it's built by CommBank. And it's helped us also achieve, it's 3 months on since launch, and we're probably the fastest growing venture in our space right now, and we absolutely couldn't have done that without having made those trade-off decisions.
Subhun, do you want to finish us off?
Yeah, absolutely. Happy to. Echoing a little bit on what both Tess and Dan said, I think the main insight for me in the last couple of years is it's a really difficult model to get right, but there's a lot of value in it. And so, I wouldn't be here 2 years ago talking about it because we didn't know what we were doing, quite frankly. We are a venture supporting other ventures, but at the same time, through real use cases, and we always say, Dan, thanks for being a guinea pig, because we almost built Unloan and X15 together. It makes it easier, right, for the next ventures and people in this room. So if you're sitting here thinking, well, how do I get involved? We've also evolved our model in terms of which ventures we work with. And so whether it be you're an entrepreneur like Dan and you want to build a business within supported by X15 from scratch, that's possible. Whether it be we've actually acquired a venture, and Justin, you would know this better than most people, but acquiring Doshi, bringing that into the X15 portfolio, but then enabling it to access CBA to let it grow rather than stifle it through corporate impost. That's been really valuable for us to learn how to do that. And then we've also started taking minority investments in existing startups, existing ventures, right? And for us, that's very selective, but at the same time, we can do it because we know now that we can distribute through CommBank's assets. And so you might have heard of Different. It's a venture that's also in the home buying space, looking at property management. Their biggest customer segments they're targeting are real estate agents and people who have investment properties. And actually, CBA has a lot of those people that are customers already of the bank. And we've managed to actually now distribute Different as well through the CommBank app. So plenty of ways to get involved. If you're broadly in the space of disrupting financial services, or you're closely aligned to financial services, whether it be conveyancing, shopping, hospitalities like Doshi is in, get in touch. We'd love to talk to you and talk about our model a bit more.
So I've just been told we do have a couple of minutes for questions if anyone has any. I think a microphone's coming down the front, down here. It's running.
Yeah, no, I didn't put my trainers on.
Hi there. I'm really interested just that challenge of like how much of a platform you build out from an X15 to enable like an initial venture like Unloan and the alignment with like CBA, and so that what can often be a bit of a chasm of like there are a very broad set of capabilities that CBA have established to support a mass market versus Unloan as a new proposition that's coming to market. Like how did you navigate like how much of that extensive like capability set that you needed to be able to like set up? And you talked a little bit sort of about it being enterprise ready from day one. That's often a bit of a challenge I see is like, well, do we need to build this because it's a new proposition versus, oh, actually we need to, as we partner with a large enterprise, it needs to be enterprise ready. So I'm interested just a little bit of commentary on like, how did you balance those two sort of polar opposites?
Yeah, great question. I could spend hours talking about it. I'll give you the high level. A couple of observations. Firstly, not all ventures are like Unloan. And so we're not here to say, Unloan has certain risk and compliance requirements that a lot of other ventures don't have within our portfolio and people in this room. So it's not a one size fits all. Having said that, the way that X15 is set up is to say there are some common things. There are common requirements that we would expect anyone from the bank, from the regulators to just say, show us how you do testing around your code environment, for example. How do we actually have some common standards and patterns that are still flexible for venturing, right? Because even Unloan is not as big as the large mortgage book that CBA has. But how do we do it in a way where actually Dan and his product team and his tech team and his design team can operate with as much agency as we can provide? Now, it's hard, right? But there are certain things that we have started designing and developing, reusable components that they can use, processes that are adjusted for venturing, so we're not necessarily going to ask them for a whole range of different documentation. We're actually going to be smarter about how we can observe that and stay in the background and let Unloan carry on running its business and pushing code into production. That's the way we think about it. If there was an easy answer, I'd say it's complex. The other thing I'd say as well is we set ourselves a goal of learning this with real use cases, because the reality is we can sit about and talk about it in a vacuum and say, we can get this handshake right, but it's only through Unloan and the 8 other ventures we've looked at. They're like, oh, that's interesting. That's not quite working. We need a solution there that is more venture-like rather than corporate-like. If you want to add anything.
Any other questions? Got one here on the left.
Hi, my name is Jacqueline. My question is for Dan, really. I wanted to ask if you could share a little bit more about the biggest trade-off that you had to make to go into this model, and what were some of the decision parameters that helped you to get to your final decision, and any regrets or any reflection post? Thanks.
No regrets on the decision. Obviously, there's always things you want to do over again, right? And think, if I'd known that, I would have pushed on a different door because it would have been faster or easier to get there. So a lot of learnings, of course, as you would imagine, when you do anything large and substantial. For me, probably one of the biggest decisions was probably on the CBA side about whether to expose its banking and payments platform to Unloan via a set of APIs which weren't available at the time. So that, as you can imagine, as Tess said, working with legacy systems, it's not as easy as it is with a greenfield startup to suddenly put a sort of zero trust API layer and make those services available outside of the bank firewalls, which is essentially what needed to happen. And if it was just for Unloan, it probably wouldn't have made financial sense for CBA to make that sort of investment. So it was obviously a very forward-moving strategy that serving Unloan in this way would not only allow Unloan to come to market, but it will also build new capabilities for CBA to deliver services in a more reusable and componentized fashion to serve other areas of its business as well, whether it be ventures or even independent business, or even other business units within the bank. So that was probably the biggest decision for CBA to make, whether to expose its banking and payment services to a venture outside the bank.
Time for one more. Anyone? Right in the middle. Oh, we've got two. We'll do short answers.
Okay, cool. I guess I'll keep this one nice and short. Hello, Tess. And I guess I'll ask, with all the infrastructure that you've set up with Unloan, if you do have to create another Unloan, what's the percentage split now? Right? As in, is it 80% you've done the work, and there's 20% effort required, or, you know, where would you put it?
Did you want me to answer that one? Oh. Nice to see you, by the way. Look, that's a very difficult question to answer, and I mean, maybe touching a little bit on the earlier question. We had to Unloan's essentially an entire bank in retail lending within the Australian market. There's a huge amount of complexity. There's a huge amount of capability that needs to sit behind just the 10-minute home loan originations process that we built. So it's you almost need to assess all of those 20 odd capabilities that we've built on a case-by-case basis to determine a level of reuse. What we did is we really focused on those core capabilities, unlocking customer account and payments creation within the bank, and really using the bank's capabilities for those key pieces. And then outside of that, it was around sort of how do we opportunistically work with partners inside and outside the bank to turn on all of those other bits and pieces that Unload would need to get to market. So, from a core capabilities perspective, it's absolutely designed to be reusable. From a partnership perspective, you need to look on a case-by-case basis, I'm afraid.
And maybe just to add one last thought to that from an X15 perspective. I think that there's this challenge that we always face between startup and corporate, where it's not so much that it's reusable. There's also a challenge around just a lack of clarity of what needs to happen, right? And so the typical kind of, well, who do I need to speak to within a corporate? There's 30,000 people and you get pinged along. And so one of the things that I think has been really valuable for us, answering your question around the next Unload or the next venture, is a better degree of clarity of where there are areas where we say, look, actually we think we're pretty comfortable. We've designed the processes that mean that you have the right level of agency and speed. But then there are areas, candidly, that maybe we haven't got that quite right, but we're working on it and this is how we work on it. Getting 2 years of use cases to have a more clear conversation up front and not waste anyone's time and be clear on what the trade-off is in and of itself really valuable.
One last question.
Yeah, last one. Thank you so much for the presentation. My main question is, where to from here now that you've delivered the product? How do you expand inside of a CBA ecosystem? Obviously, they've got their innovation. You'll have your innovation. How does that work hand in hand together?
Dan?
For Dan, I think.
Where to for Unloan or where to for Commonwealth Bank? So for Unloan, number one is we're focused on radical simplicity. So I think most startups will know this. You want to be super focused on who your customer is, and you want to be super focused on your product set. It's always tempting to try and serve more audiences or try and add feature upon feature upon feature. Our view is success equals refining what we already have and expanding our reach to more customers, but remaining really, really clear about what we do well and continuing to strive to be the best at that.
Yeah, and from a CBA perspective, we keep evolving this product or this service, these banking services that we've exposed for Unloan, and we have many other consumers inside the bank who want to use those capabilities as well. So continuing to drive quality, continuing to add features and build it out.
Thanks, everyone, and thanks, everyone, for listening.
Thank you.
Thank you, Daniel, Sapun, of course, just everyone. Well, you've built your product, you've got a market. Can I also say 285, not bad, and I don't know what you've decided to do about yesterday, but to Unloan's credit, I did note that when the RBA met last month for 50 basis points raised, they only put theirs up by 40. So, well done.
Thanks to that.
Yeah, exactly. Keep it going. Thanks, guys. Well, that was a really fascinating conversation about big, small, and brilliant. But let's look at using venture debt to accelerate startups, which is our next panel before we break for morning tea. So I'd like you to welcome to the stage Justine Carzino from One Ventures, Jody Imam from Tractor Ventures, Ian Gardner from Lighter Capital and Geelix Ventures. And our moderator today for this panel is John Bailey from Invest Victoria. Please come to the stage, all four of you. And put your hands together as you come in or out. You can clap and walk at the same time, everyone leaving.
We might just wait a few minutes for the crowd to come in.
Testing.
Yeah, where's everyone going? Come back.
Does it all work? Well, let's kick off. We've got a lot to get through in this session. So good morning, everyone. This is a big hall. If you want to get closer, please do. We're going to be today talking about venture debt and how it can help startups in their growth plans. Probably to start with, just to introduce myself, John Bailey. I'm with the state government, Victoria, and we've participated a lot in venture debt. We have been a cornerstone investor to set up a venture debt fund called the Venture Growth Fund. We have two managers for that. One is One Ventures, and the other one is Lighter Capital. Also, one of our sister organisations, LaunchVic, has supported Tractor Ventures, and we have Tractor Ventures here today as well. So with venture debt, we're going to take it apart. We're going to talk about the what, the how, and the when. As I said, we're going to leave some time at the end for some questions. We have a good panel of practitioners here, venture debt practitioners here, and I'll go from the far end. We have Ian Gardner, who is he's a partner at Geelix Ventures, but also a market development director person for Lighter Capital, so involved with Lighter Capital. Next is Jody Imam, and so Jody is co-founder and COO for Tractor Ventures. And next is Justine Carzino, who's a director for One Ventures. So maybe I think how we should start this off is really just go along the line, and for each of you to have an opportunity to talk about your business, what areas you focus in. I think one of the real issues with venture capital is it lends itself to too much generalisation or overgeneralisation. So there's different parts of the market that people are involved in. So maybe I'll start off with Justine first. If you just want to introduce yourself and One Ventures, etc., and your area of focus.
Yeah, thanks, John. So like John said, I'm an investment director at One Ventures. At the moment, One Ventures has 2 active venture debt funds, one of which is our Victorian Venture Growth Fund alongside Invest Victoria. And we typically invest in businesses from around about Series A onwards. Our minimum loan size is $1 million, and our largest loan size was $20 million that we did alongside our partners in Israel, Viola Credit. In terms of our strategy, we really are kind of multi-strategy tech, and so our existing investee companies span from everywhere from aviation and space technology all the way through to digital consumer health.
And Jody.
Thank you. So at Tractor Ventures, we exist to unlock possibilities for founders. We like to talk about rockets and tractors, and the rocket is the symbolisation of the VC model, which, rockets are very exciting and some of them land on the moon, but a lot of them blow up along the way. Whereas tractors we're finding equally as ambitious, but more sustainable, hardworking. If you said to the farmer, I'm sorry, we're going to take away your tractor, she or he's most likely going to be pretty upset. So we're starting with revenue-based finance and also advice for founders, so that for technology companies. So that can be, it's completely industry agnostic, so across all industries. We've supported 50 companies so far in our 18 months. And yeah, our check sizes are from between 50,000 and 1.2 million at the moment. They're growing, it's growing bigger as we go on. What else can I tell you? So yeah, we've started with revenue-based finance, which is effectively a loan against future revenue. It's very flexible, and so you pay back as a percentage of your revenue, so then the repayments float as your revenue floats as well. It's also unsecured lending, so it's very flexible for founders.
And Ian, please.
Okay, welcome. I wear two hats, so I am a VC, a little bit like Justine. I'm a VC with Gelix Ventures, but we also love debt, and they're not competitive, we don't think. Lighter has been around since 2010, headquartered in the US. It's done 1,000 loans, deployed about 250 million over its lifespan. Very similar to Tractor in terms of the focus and the practicality of it. So revenue-based finance, some term loans, and yeah, typical check size is anywhere from 50,000 all the way up to 4 million if the stars align. It's been active in Australia for a couple of years now, and yeah, no, it's very accretive and symbiotic, I think, with the venture world, the debt world.
So maybe just to talk about the current environment at the moment. So we've seen equity valuations to be very volatile. It appears to be a good market for venture debt to extend that cash runway. But maybe just a few comments about where venture debt is at the moment and the outlook for it going forward. And maybe, Ian, I'm going to say you have the microphone, you all do, but anyway,
yeah, sure.
You have a go first.
So, I mean, I'll maybe just touch on that macro environment. The thing that's been clobbered in the current environment is the late stage businesses in particular. So the closer you get to the public market, the more you're getting affected. Where we play, most of us on stage here, is at that pre-seed and seed stage. I think I read a report the other day that was suggesting that there's actually been no change in valuation at the seed and pre-seed level. Gelix, for example, is a 10-year fund. 10 years from now, the economic cycle will be different. It's actually a really good time to invest. And I think that is cascading through to the venture debt world as well. It's a sophisticated environment that we're in now. So founders are fantastic. Most of the ones we're talking to have got really good, sticky, recurring income. Australia is very strong in that B2B SaaS, which is perfect for venture debt. And it's fairly new, I think, for all of us on stage here. So the trajectory is still up and to the right is kind of the punchline that we're seeing. So rumors of the demise in this sector are grossly exaggerated if you're hearing them. So it's pretty good.
Jody or Justine, do you want to make any comments to that?
Yeah, absolutely agree. I think it's a positive environment, and we've seen, like for us, it's been tailwinds. I mean, everyone getting nervous about their valuations has caused founders to call in, and really, I've noticed, having spoken to about 400 founders since we launched last year, that they've definitely gone from curious to serious now about venture debt, and really, how can they use different sources of capital to grow their company, not just that one option. So. Yeah, I think there's lots of positive momentum.
And Justine, can I put a spin on my question to
Sure.
you on the same subject and that? But just looking at like those mature markets, like in the US, and the size of it as a percentage of VC fundraising. So, and what we are like here at the moment, and it's a developing market and it's got a lot of headroom. But maybe just to talk about how large the US market is and how large it is in Australia and where it could head to.
Yeah, well, obviously, venture debt features a lot more prominently in the startup and scale-up industry in the US than it does in Australia. But I really do think that that's probably just symptomatic of the fact of how quickly the VC and startup ecosystem has grown in Australia over the past 5 to 10 years. And I think the venture debt sector will just grow proportionate to that. I do think, perhaps Australians maybe are a little bit more on the conservative side about debt in general and tend to be, compared to our US and EU counterparts, perhaps a bit more concerned about leveraging up too much. But I think it's all about education at the end of the day. Once people become a little bit more educated around the difference between the types of debt financing that you can get and how, all of us, we're all venture debt providers and we are very, very different from a big bank. and we operate and behave very differently. So I think once we can get that message out there, people will kind of generally start to become a little bit more comfortable about incorporating debt into their capital stack.
Interesting. I just saw recently about some of the sizes of the debt raises for startups in the US. They're about $1 billion size. So, it's a very large market. I think one of the real advantages of venture debt is how it's non-dilutive and just that whole, position for startups that you don't have to give away a stake. So maybe, Jody, do you want to just have a kind of response to that and one of the benefits of venture debt?
Yeah, thank you. It's the whole reason, we exist. We want to be able to provide founders this option where they don't have to sell parts of their company. And often, especially at our early stage, you're selling quite a big chunk usually for not very much money. We compare, like if you were to compare that as an interest rate, selling your shares really early, investors expect a big return over time. So at a pre-seed stage, we've worked out, it sort of works out to be about 400% interest is what you're paying. So sometimes founders think that it doesn't cost them anything because it's not cash they're paying right now, but it actually, over the long term, it costs a lot. And the other thing is once you've sold those shares, you can't get them back, really. Like you can, but it's really hard. So, that's where using debt, especially in the early stages, is a really smart way to look at capital for your company over time.
Justine, Ian, want to comment on that?
I could definitely add to that and probably go even further to say that at the end of the day, equity multiples and valuations are impacted by a whole range of things. Obviously, at its core, your tech and business model, but your size and how fast you're growing as well. And both of those things can be optimized with the use of debt. So it just means that not only are you giving away more equity than you have to at this point in time, but if you can utilize some debt in your capital stack, you can effectively raise at potentially a much more favorable valuation and dilute yourself even less in future. So something to think about in terms of the timing of when you want to strike that equity raise in future if you do choose to do so.
Yeah, I've seen some interesting case studies that you've presented on that, which is quite interesting how much money can be given back to the founder.
Yeah, but ultimately, if you're a startup that's considering either debt or venture or a combination, the reason you're doing it is to grow faster. And the reason you're doing that is because you're ambitious, you don't want to get steamrolled by your competition. So ultimately, the outcome from that should be a much more valuable company. So as a shareholder in that, whether you're the founder or the venture capitalist behind it, more money into that business in any form is going to help those shareholders. So this is why I think this is such a great instrument, venture debt, because it is building that wealth within the company for the shareholders, including the venture capitalists too. So everyone benefits. I think it's really good. I think it's going to become much more common in the future. It may not be well known now, but in 5-10 years' time, it's going to be pretty much default.
It also speaks to that issue about the difference of cost of equity versus cost of debt. Most people think that not most people, but people do think that equity is free and debt's expensive. But I think that's kind of an important distinction. But does anyone want to maybe make a comment about that?
I think it's probably the case because returns for debt providers are visible. And so perhaps that's why it seems to be more expensive when actually it's not. At the end of the day, debt sits higher on the capital stack than equity, so it should always be cheaper than equity. It's just that, our returns come along the way, and like I said, they're more visible than what equity returns are. So I think that's probably what leads to that misconception.
Maybe just to move on to some kind of real transactional kind of issues and around the documentation. How long does it take if you wanted to do a venture debt transaction? How long does it usually take from start to end?
Well, for us, from the time we first meet a founder, we can have money in the bank within 2 weeks. So it's much quicker.
Yeah, it's pretty similar. Like 2 to 3 weeks is at the sharp end. I guess average is probably 4 or 5.
Yeah. Justine, about the same?
Yep, pretty much exactly what Ian said.
And is documentation relatively standard? Is it is it fairly standardised, and is that one of the reasons why it's so quick to transact?
Jodie's the operational guru at Tractor, and I know your processes are pretty fantastic, but Lighter has built its own DD transaction engine that sits behind it, and it's pretty sophisticated, and it's as you'd expect. You need to submit your financials, and you need to get a pretty clear understanding of where your money is, where it's coming from, fairly standard stuff, but once you've opened access to your MyOB or Xero account, then it becomes much, much simpler. So it is pretty standardized, and it is quite process-driven.
Just the use of warrants in venture debt, maybe Justine might be a bit more applicable to yourself, but just to talk about how warrants are used in venture debt.
Yeah, sure. Well, I mean, it's a really good case study because I think we all have different approaches to this. One Ventures, the terms typically involve an interest rate and warrants that attach to the debt. The way we view warrants is it effectively gives us a long-term interest in the business. That can be actually pretty handy during downtimes, including during COVID, or in situations where it can be really difficult to raise capital for some startups, including the current market. What it means is that we're effectively not thinking only with our lender hat on, because some of our return is tied up in the long-term success of that business. So we just find it's really helpful in terms of the type of support we can provide to our businesses during challenging times, because we do think, a little bit more long-term, and we're invested in that eventual success of the business.
Anyone else want to make a comment on that?
I definitely agree with that. We like the phrase, we're here for the long time, not the loan term. And that's very much where the warrants come in. We've actually split out our warrant part of what we do. So our loan agreement is strictly just the loan, and then our warrants are tied to our advisory. And so we've got a huge, village of investors and ex-founders and experts in growing global companies that we can access for our investees. And so that's optional. So if they want to give us some warrants, we'll agree to pay for the warrants and earn them. But if we do that, then that's very much tied to the advisory services that we offer.
I've got a very simple answer. Lighter does not take warrants. It's just, so there is no venture in the venture debt component. It's just debt.
And is that a deliberate strategy? I mean, is that your business model, as I should say?
Yeah, I think so. I wasn't involved in that strategic decision, so I can't really comment too much on it. I mean, I think it's sensible. It's not that you have to be one or the other. One Ventures is a good example. They're a VC as well as a debt provider. But I think it's just clearer. If you talk about the, money without dilution, warrants is a form of dilution. So without that, I think it's just clear.
So we never want to get to this stage, but what happens if things go bad? I mean, what do you do in those situations? So maybe Jodie, I'll start you off with that question first.
Thanks. I've got a great story I love to tell. In one of our companies that we loaned, actually one of our very first loans, they got into a bit of trouble with their cash flow about a year in, and they came to us and wanted another loan, and we assessed the state of the business, and we realised that if we gave them another loan, it might even sink them. So we said, we can't give you another loan, but what we'll do is help you find the right equity investor to give you the cash injection you need right now, which we did, and now they're really on the up again. So it's always going to be in our interest to help the founder unlock the right capital for the part of the journey that they're in.
Does anyone else want to make a comment on that?
I think that's a great answer. I mean, that's the way that any lender or any venture capitalists, like one of the key things they can do is to provide introductions. So, I mean, that's awesome. Look, one of the great things about revenue-based finance is when cash flow is tight, you're not calling the loan. So Lighter doesn't have a minimum repayment. So if you literally are receiving no money in a certain month, there's going to be no requirement to pay anything in that month. So it kind of levels itself out within the terms of that loan.
Yeah, I mean, the only thing I'd add is that we've obviously been through one of the most challenging market environments over the past couple of years. We have, businesses in our portfolio who were, very obviously decimated during COVID, and nothing's gone nuclear yet. We've been able to support them throughout the whole process, and now they're posting the largest numbers that they've ever had. So in short, there's definitely things we can do to support them during those times.
Just going forward, just looking at the evolution of venture debt and what it could be used for, working capital lines, committed lines, and so forth. But maybe a comment about how do you think it could evolve and what could be the drivers for the market going forward. Ian, did you want to have a shot at that, or
I
pass it down the line as well?
I doubt you're going to see it evolve to the point that you're getting shareholders bought out with it. So I think that's a use that it won't be. It's really just that working capital. The money's coming into the business to accelerate the growth of the business. So it's really to hire staff. I don't think you will not be seeing it, I don't think, used for getting cash off the table as a founder. There's other mechanisms for that. And I think it's just going to remain the same, to be honest. I mean, the cash is coming in to accelerate the growth in the business, which really in the SaaS software space, which is where most of us play, salaries. So that's I think, I don't think there's going to be much change.
Just go down the line if.
Yeah,
and sorry, Jody, before you start there, we'll ask some questions of the audience very soon, so get your hands ready.
Yeah, I'll just add to that. Like the use cases that we're seeing for revenue-based finance is, it's really that short ROI kind of stuff. So if you've got an advertising sort of campaign or an acquisition strategy that's working, and if you put $1 in, $4 is going to spit out, then that's exactly the sort of use case you want to use this money for, as opposed to hiring engineering teams that are building longer-term product. That's where you really probably want to look at equity capital. So it's that shorter ROI stuff.
Yeah, I'd agree with that. I mean, maybe with a slightly larger loan size as well, we tend to look at overseas expansion opportunities as well. It is a little bit more uncertain, but it is a common theme at the moment. By and large, we're seeing pretty much just extension of runway at the current time. I'd love to see more acquisition financing. It's a bit of a wild card in the venture debt space, but in the current valuation environment, I think could be some good opportunities there.
And committed lines, is that something which is evolving?
Yeah, I mean, it's always been an option, so for sure.
I've got a couple of final questions here, but maybe just to the floor. If anyone's out there wanting to ask a question, please put your hand up. I was told by Ian the first one's the most difficult one.
There's one down in the front here, Stu. Get your trainers on.
I need to start up with a hoverboard. Hi. So I'm from the UK, as you might be able to detect, and their venture debt doesn't tend to be used right at the start. Definitely tend to kind of follow on from an equity round once you've got a bit of traction going. But it sounds, certainly from what you were saying, Jody, that perhaps in Australia that's a bit different and people can use it right at the start of the venture. So just interested on kind of how that works.
Yeah, great question, actually, because I would say it's not really right at the start, because the companies, especially for us and for Lida, well, I guess all of us, there needs to be revenue. So there already has to be, for us at least, $15,000 a month in revenue. So it's not right at the start, but it certainly can be early. We do have a lot of our companies as well that have taken some initial angel funding or family and friends cash already, but yeah, it's early in the revenue journey.
Maybe a quick comment on that. Australia is very heavy in B2B SaaS. I mean, that's our specialty. We don't have too many consumer businesses, and that's tougher for venture debt to participate in anyway. So I don't know whether there's a slight difference there. I don't know enough about the UK despite my accent.
Any other questions out there?
Just talk amongst yourselves.
Hi, everyone. Just a quick question around venture debt and allowing sort of founders to get senior finance in future. Does that help with credit worthiness for companies who are scaling up and so forth?
You mean from an equity investment perspective or what?
Well, does venture debt sort of bridge them in terms of getting or securing senior finance in future? And does that sort of allow them to get longer term finance in the future?
Does anyone want to answer that?
I'm looking at Justin. But.
Yeah, I mean, we haven't experienced any tension around that. You know, I think all of us are in a situation where you're free to repay the loan as you like, alongside the terms of the loan agreement. So it really shouldn't impact it at all. If anything, it means that you've already gone through the DD of a lender. So.
Yeah, I mean, experience is quite good when you're trying to do these things, and people are a lot more comfortable going forward. Other questions there before I go into the final ones? We've got one right at the back there.
Yeah, thank you very much, everyone. It's been really informative. To bridge the gap between startup, where you don't have the revenue metrics to meet a debt position, what would you recommend? There's obviously pre-seed and seed. There's safe notes that seem to be talked about a lot more now. What are your preferences to get you to that revenue phase where a debt option is more attractive or possible?
Probably Ian or Jody for that one.
I mean, look, you're at really early stage. Is that where you're at? Look, the reality is it's really hard. I mean, crossing that chasm from not having anything, you know, so you need money to get your business off the ground, but you can't get your money because you don't have your business off the ground. The answer is hustle and favours. So you kind of get goodwill with your friends, your family, normally once in your life. Now is the time to use it. Call in those favours, pull out your credit card. You know, I wouldn't necessarily recommend taking a loan against your house, but you know, if you've got nothing else, you just got to demonstrate that you can actually build the product and the company, and you know, demonstrate some form of traction. Sometimes that's revenue. If you're looking for venture debt, it would have to be revenue, but in other businesses, if you're looking for equity investment, there may be other metrics that count. But that first phase is all about hustle.
I think there's one question down the back there.
Just on the sort of risk-reward spectrum, I guess this is obviously the sort of higher end of the risk spectrum, but can you talk to general kind of rate costs around this? I mean, you know, many founders look at sort of putting stuff on the credit card, which you kind of think is your sort of upper bound of what debt might cost. Are you sort of below that, above that, around that sort of number?
I think all three of you have probably answered that one.
Well, I think credit card is a good analogy. It's kind of that credit card sort of interest rate. That's how, I guess, it's hard because you don't know what's going to happen with the revenue. You don't know how long the loan's going to take to pay off, so you don't actually know what the effective interest rate is. But you could think of it as that sort of credit card, you know, point.
Yeah, mid to high teens, depending on the risk profile and the way, and it can be lower, it can be slightly higher.
And then, you know, One Venture's in a bit of a different boat because we're a bit later stage, so it's kind of low double digits.
Okay. So I'm going to the last question from the panel here, or my last question, but is anyone else from the audience? If not, then maybe just a closing comment from everyone, just about any advice you would give for a startup, and we've been touching on a bit of it already, any advice for startups in the next 12 to 18 months. What should they do to get themselves prepared for a potential a venture debt transaction? So maybe, Justine, I'll start with yourself.
Sure. Well, as a start, I'd definitely encourage founders to be really thoughtful about their blended cost of capital. I think, you know, I see a lot of founders just go default down the equity raise route, and while that can be, you know, venture debt isn't for everyone, so that can be appropriate for some types of businesses. I do think that there's a lot of missed opportunity to overall lower their dilution and the amount of pie that they get when they eventually do exit at the end of the day. So yeah, I'd just love to see founders be a little bit more thoughtful, maybe think about getting a couple of venture debt term sheets to compare. And you know, it's also not binary, right? You can also raise, if you're thinking of doing a $10 million raise, you can do 5 with equity, 5 with debt, with 2 really, really reputable firms, and have, you know, potentially more optimal outcome for yourself. So I'd have a think about that. I'd also have a think about any really large expansion opportunities available. Think about what that ROI is and whether it could be more profitably funded with debt which has a lower cost of capital.
Yeah, great.
Yeah, 100% agree. And I think like we like talking to founders early on, even before they have revenue or before they have our minimum revenue, and it's just knowing your options. That's the key thing, knowing your options and asking for help. Like there's a lot of people who've gone down this path before you, and they're happy to help. So I think it's just, really reaching out and laying out all your options, and not thinking about debt as a dirty word, or, associating it with childhood memories of debt or whatever, or the credit card buying the LCD TV. It's more like, what is the most effective use of capital, and what's the best way to leverage the capital that you can get to grow your business?
Yeah, and debt providers like us like sticky, recurring, high-margin revenue. So, as you're growing, sometimes you'll be, to my hustle answer before, you might be reliant on some services income. But ultimately, to get venture debt, that's going to translate over into product income. So that's really what you'd focus on. How can you go from service-based income, or more, if you have that, like transition over to that product-based income?
I think we're just about to close up, but any final comments from the panelists there?
Look, I think we'll all be around all day, so come and grab us at the breaks.
Look, I'd make one last pitch. As I said at the very beginning, the Victorian government is really a believer of venture debt. We've stepped in with a number of the venture debt providers and are working with them to try and develop the market. Not only are we doing venture debt, but we're also looking at doing setting up equity funds as well. So we're very active. The government is a very big believer that startups is where job creation and economic growth comes from. So they understand risk and they understand rewards. And so you will find the government out there partnering. We don't know the industry, we partner as we have, but very much partner in the market as well. So with that, I'd like to just close it. I think we're right on time.
Nailed it.
We're not.
I said you nailed it.
Nailed it. So just to thank Ian, Jody and Justine, thank you very much, and to the audience as well.
John. And thank you to John too. That brings our first session of the day to an end. You've earned coffee, tea and a croissant. We'll see you back here in 15 minutes. It seems like it's a permanent networking out there, so we're going to take a short break. Come back 11:15 for our next session. See you in a minute.